Hello everyone and welcome to another episode of Money Talks. I'm Zidan and joining me today is my co-host Karim. In today's episode we'll be diving into the fascinating world of fiscal and monetary policies, exploring how governments and central banks use these tools to manage economies. Let's get started.
Absolutely, Zidan. Fiscal and monetary policies are fundamental in understanding how economies function and how policymakers intervene to achieve specific goals. Let's begin by understanding the difference between these two types of policy.
That's right, Karim. Fiscal policy refers to government actions related to taxation and spending. The objectives of fiscal policy include influencing aggregate demand, promoting economic growth, and achieving price stability. For example, when an economy is facing a recession, the government might increase spending on infrastructure projects to stimulate demand and boost economic activity.
On the other hand, monetary policy is managed by central banks and involves controlling the money supply and the interest rates. The primary objective of monetary policy is to regulate inflation, ensure price stability, and support overall economic growth. Central banks use tools like adjusting interest rates, conducting open market operations, and setting reserve requirements to achieve these objectives.
That's a great overview, Karim. Now, let's talk about fiscal and monetary measures that are used in Egypt to manage inflation and stabilize the economy.
In Egypt, fiscal measures to combat inflation may involve adjusting tax rates or government spending. For instance, the government might increase taxes on luxury goods to reduce excessive consumption and counter inflationary pressures. Conversely, reducing corporate taxes or increasing infrastructure can stimulate economic activity and during periods of low growth.
Definitely, Karim. Meanwhile, the Central Bank of Egypt, or CBE for short, is implementing monetary measures such as adjusting interest rates. When inflation is high, the CBE might raise interest rates to curb spending and reduce inflationary pressures. Conversely, lowering interest rates encourages borrowing and spending, which can stimulate economic growth but must be carefully managed to avoid overheating the economy.
Additionally, the open market operations play a crucial role in monetary policy. The CBE buys or sells government securities to adjust the money supply in the economy. Selling securities reduces money supply, helping to control inflation, while buying securities injects the liquidity to stimulate economic growth.
It's fascinating to see how these policies work together to steer the economy, Karim. Both fiscal and monetary measures have implications beyond inflation control, influencing employment levels, exchange rates, and overall economic stability.
Yeah, absolutely, Zidan. It's important for policymakers to strike a balance between the policies to achieve sustainable economic growth while maintaining a price stability.
That's all the time we have for today's episode of Money Talks. We hope you found this discussion on fiscal and monetary policies insightful. Join us next time for more discussions on finance and economics. Until then, this is Zidan and Karim signing off.